You finally finished medical school but with $300,000 in student loans. You just signed your first attending contract and now you're wondering how on earth you'll ever buy a home. Here's the secret most physicians don't know. Banks actually want to lend you money. A lot of it, with no down payment, no private mortgage insurance, and they'll often ignore your student debt entirely. It's called a physician mortgage loan. In the next 5 minutes, I'll show you exactly how it works, when to use it, and the costly traps to avoid before you sign anything. Here's the problem. Traditional mortgages weren't built for doctors. You spent your 20s in training. Your debt-to-income ratio looks terrifying on paper. You have minimal savings and you're often relocating across state lines for a new job. A conventional lender only sees risk. They want 20% down and they count every dollar of your student loans against you. And many of them will deny you outright. But physician mortgage loans flip the script. Lenders see something different. They see future earning power, so they offer terms regular borrowers can only dream about. Let's break down the 5 things you need to know. Key point 1, what makes a physician loan different? What actually makes a physician loan special? There are 3 core features. 0 to 10% down payment on loans up to $1 to $2 million. No private mortgage insurance, even with nothing down. And flexible student loan treatment. That last one is huge. Most conventional lenders use 1% of your total student loan balance as your monthly payment. So if you owe $300,000, they assume a $3,000 monthly payment, which tanks your debt-to-income ratio. Physician loans often use your actual income-driven repayment amount, sometimes as low as $0 if you're on PSLF. That single change can mean the difference between approval and rejection. Key point 2, who qualifies and when most programs accept MDs, DOs, dentists, and sometimes veterinarians and podiatrists. Some programs will include nurse practitioners and physician assistants. Coverage varies by lender. You can typically close on a physician loan up to 90 days before your start date. Just bring your signed employment contract. That's a game changer. It means you can buy a home before your first paycheck hits, before you've moved, before you've even worked a single shift. Most programs cover you through residency, fellowship, and attending years. But the best terms usually go to attendings. Residents may face slightly higher rates or lower loan limits. You have to shop around. Key point 3, the real cost comparison. Let's talk numbers because 0 down sounds amazing, but is it actually a good deal? Here's an example. You buy a $600,000 home. With a conventional loan, you'd need $120,000 down plus closing costs. That's a lot of capital that took years to save. With a physician loan, you put down 0. You skip PMI, which on a conventional low-down loan would run you $200 to $400 a month. Your interest rate might be slightly higher, maybe a quarter point, but not always. The trade-off is clear. You preserve cash for emergencies, investing, or paying down student loans, but you start with little to no equity. If the market dips, you could end up underwater. Run the math for your specific situation. A good loan officer will show you both options side by side. Key point 4, the traps that cost doctors thousands. Trap 1, buying too much house. Lenders will approve you for $1 to $2 million. That doesn't mean you should borrow that much. Keep your housing payment under 28% of your gross income. Trap 2, buying in your first year at a new job. Statistically, a huge number of physicians leave their first attending position within 2 years. Selling a home with 0 equity and closing costs? You'll write a check at closing. Trap 3, skipping the rate shop. Physician loan rates vary wildly between lenders. Get quotes from at least 3. Local credit unions, regional banks, and specialty lenders like Bank of America, Huntington, TD Bank, and First Horizon all compete in this space. Trap 4, forgetting about property taxes and maintenance. Budget 1 to 3% of the home value per year for upkeep. That's not optional. Key point 5, when not to use a physician loan. If you have 20% to put down and a strong credit profile, a conventional loan may actually offer a better rate. Run both scenarios. If you're not sure you'll stay in the area for at least 5 years, don't buy at all. Rent. The transaction costs of buying and selling will eat you alive. If your student loan situation is unstable, like you're job hopping for PSLF, wait until things settle. A mortgage is a 30-year commitment. And if buying stretches you so thin you can't max out your retirement accounts, You're trading long-term wealth for short-term square footage. Bad trade. Here's a summary of your action plan. 1. Pull your credit report. Aim for a score above 740 for the best rates. 2. Get pre-approved with at least 3 physician loan lenders. Compare rates, fees, and loan limits. 3. Calculate your true affordability. Total housing costs should stay under 28% of gross income. 4. Wait until you've been at your job for 6 to 12 months if possible. Stability matters. 5. Work with a real estate agent who has closed physician loan transactions before. They know the timeline quirks. If this video saved you from a costly mistake, hit that subscribe button. We drop new content every Monday, Wednesday, and Friday to help physicians build wealth and avoid financial traps. This content is for educational purposes only and does not constitute financial or legal advice. Always consult a qualified mortgage professional or financial advisor before making any home buying decisions.